Good afternoon, everyone. We'll be calling the meeting to order at this very moment. I believe we have over 50% of the registered participants present already, so we can move right along with the proceedings. So I hope the secretary is recording, and this meeting has been officially called to order. So we'll open in a word of prayer. So let us have a moment of reverence. All right, so Lord, we'd like to thank you for this wonderful opportunity to meet as professionals. We thank you that you have seen it fit for us to gather and to discuss this important matter that will be brought to light by Mr. Karl Allison. We pray, Lord, that you will help us to be persons of integrity, of righteousness and loving kindness, so that we may contribute in a sincere and meaningful way to the real estate industry and the built environment on a whole. We pray, Lord God, that you will provide insight, you will provide clarity, and that we will all go away being more informed, so that we will play our part in advancing the whole human race. We give you thanks even now in the mighty name of Jesus Christ of Nazareth, our Lord. Amen. Right, so we would like to thank you all for joining us for this CPD session. We are glad that you are able to join. So the committee, the leadership committee from ALEVS welcomes you wholeheartedly. We are joined by persons from UTEC and other jurisdictions in the Caribbean. So we are glad to have you. So welcome ALEVS members and also other professionals who have joined us from different areas of expertise. So today we will be fed some good learning material by Mr. Karl Allison, and he will be introduced in very short order. So we are glad for the turnout. We know that you all are very busy persons, and we are happy that you could have taken the time out from your schedule to join us. So without further ado, I'll ask the very capable Mrs. Cadian Arthur Spinock to take the floor at this time and introduce to us our guest speaker.
Thank you so much. Good afternoon, everyone. We are here to benefit from the information that Mr. Karl Allison has to present to us. But who is Karl Allison and what is he all about? Now, Mr. Karl Allison is a graduate of the City University London with a Master's of Science in Property Investment Analysis and Finance. He has a Bachelor of Science in Land Management from the University of East London and a Diploma in Land Economy and Valuation Surveying. He is, of course, a member of the ALEVS, Land Economy and Valuation Surveyors, and a fellow of the Royal Institute of Chartered Surveyors, London. We all know that is RICS. Now, Mr. Allison has over 30 years experience in the real estate industry. He started his career at the then known Life of Jamaica Limited in 1988, and he's left there in 1991. He operated as an estate supervisor, where he carried out duties as a property manager, negotiating and carrying out maintenance for contracts and rentals. He then moved on to Allison Pitter and Company in 1994, and he started there as an associate and then progressed to where he is now as a partner. His years of experience at Allison Pitter has been numerous, where he has gained and garnered lots of experience in property management, valuation for sales, letting, mortgages, probate and estate duties, asset valuation, fire and peril insurance. Without a doubt, he has also competence in commercial valuation, and therefore he has the ability to impart lots of information to our benefit here today. Let me take the opportunity to now welcome and invite Mr. Karl Allison. Mr. Allison, the floor is yours.
Afternoon, colleagues. I've been tasked with speaking on the practical application of the investment approach in valuations. Few caveats. One, we're going to be looking solely at fee simple interest. We're not going to be looking at any kind of partial interest or any other interest. So we're looking only at the valuation of fee simple interest. Secondly, it's a practical application. So we're going to base it on what applies here in Jamaica as best as possible. I hear that we have some other islanders with us. Hopefully you'll still find it useful. It shouldn't depart too much from the theory. The plan of this presentation is I don't want to speak for more than probably half an hour to 40 minutes at most. And then we open the floor hopefully to what will be a lively discussion. I will introduce a couple points here and there, and hopefully will stimulate some thought and some discussion. All right, well, let's just get straight into it. The two basic methodologies on the investment approach or income approach are your direct capitalization or your yield capitalization. The direct capitalization is where we use an all-risk yield as we know it, or a cap rate, to capitalize a single year's income into an indication of market value. In the yield capitalization, what we use is a projected income flow over a holding period, at the end of which we presume the property is resold, and we discount all of that to present value. What we will specifically be discussing today is discounted cash flow only. So we'll be looking at all risk yields and discounted cash flow. Why? Because these are the two most commonly applied that we have found here in Jamaica. The two principal components of any investment approach are your net income and your rates of return. Those are the two items that we're going to spend all our time on. So going straight into it, on the net income side, let's start with leases. You have different types of leases. We're just going to run through some general concepts. I don't want to get stuck on them because I'm going to try and relate as best as possible to what pertains most in our marketplace. So the different types of leases. You have flat leases where the rent is negotiated and it's not changed throughout the period of the lease. You have variable leases, which are often tied to an index, such as CPI or some other index. You have step up, step down leases where the rent moves up or down, and that's usually used to often accommodate tenant improvements or works executed by the landlord on behalf of the tenant. So you may pay more rent at the upfront to recoup some funds that were spent by the landlord. As a for instance, you have revaluation leases where periodically the lease is revalued to whatever, to market value. And usually there is some formulation set as to how that revaluation process takes place. You have annual increase leases, which are probably more common in Jamaica, where there is a set per annum increase over the life of the lease. And it may go to a revaluation the further down in the lease. And then you have percentage leases. Percentage leases. Percentage leases are rare in Jamaica. I don't know about the rest of the Caribbean. They usually apply more to retail leases, where a part of the rent is determined by the performance of the tenant. It usually goes hand in hand with a minimum rent being set and the percentage being called an overage. So once the minimum is achieved, then the overage kicks in on the percentage rent, on the percentage lease. Coming out of these leases, you have different types of rent. You have market rent, which is what we are going to spend our time with trying to figure out. And market rent is defined no differently than market value, willing lessor, willing lessee, etc. Everybody has perfect knowledge. You have contract rent. Contract rent is the rent as we both have agreed, landlord and tenant. It is the rent passing. It may be equal to, it may be less than, it may be more than the actual market rent at the time. You have effective rent. Effective rent is something also that we're going to be interested in along with market rent, because effective rent nets down your market rent to take account of any adjustments that may have been made for tenant allowances or improvements. So where rent-free periods and other such things are given, we are taking them back out of the contract rent to come back to an effective rent. Excess and deficit rents pretty much are the difference between your contract rent and your market rent, where it's higher or lower than the same. Percentage rent comes from your percentage lease, and your overage rent is the amount of the percentage rent that's over your, well, what's deemed here to be your market rent. One thing starting right here, when you're doing an inspection or doing a valuation, you will want to see schedules of all leases. Meaning it is not unusual to ask your client for a schedule of all leases. You want to know start date, end date, absolute rents, and you want to confirm as best as possible where you don't get the leases, where you get a rental schedule. You want to confirm these as best as possible with the tenants during your inspection. You can't sit down and assume that the rents that you're given were correct. If you do, you could be negligent. Right? So at the date of your inspection, and again, it's a suggestion. I can tell you from years of practice, very few tenants are going to share that information with you. But don't let it be said that you didn't ask. All of these rents and leases all feed into the whole concept of what we are trying to figure out, which is market rent. Now, to get market rent from all of this information, what we're going to do is a few steps. We're going to gather, compare, and adjust our rent comps. So what we're going to do is go out and we're going to try and find all the rental data we can for all the rents, all leases that have been executed. For those, we want to look at arm's length transactions. Same thing as in market value. And arm's length transactions here is the things you want to avoid or you want to note, make good note of, is where the lease could be to the owner or a related party of the owner. Or the lease could actually be the subject of a sale and leaseback, because the actual negotiation at that point does not become arm's length, because the parties are trying to achieve different things than necessarily market conditions. One is might be trying to get to the point of an operating cost that they can deal with, and the other one could be just looking for a capital figure that they want, and they will sacrifice the other side of that equation at times to meet their objectives. Once we have gotten all that data, what we want to do is reduce all of it to a similar, singular basis. What I would say you want is your net effective rent. So from your gross rent, from whatever rent information you've gotten, you want to know, put it in a per square foot basis. There's also the question of currencies, whether or not it's denominated in Jamaican dollars or not. This is Jamaica, so I go back to whatever the lease says. If the lease says it's US dollars and it sets a fixed rate, I use that rate. If it says it's US dollars, I convert it to Jamaican dollars as of the date of my evaluation. Right. So once you have reduced all of that to a per square foot basis, the next part is to start making adjustments. The adjustment factors that you're looking at are, you're looking for newly executed rentals versus renewals or extensions. i.e. we're looking at new tenants versus sitting tenants, because arm's length again changes, meaning when I'm coming in for the first time and the two of us are sitting down on a lease negotiation is different than when I'm already here, because our motivations change. One, I might have done significant tenant improvements that I want to protect and I don't want to move, or two, you might be the greatest tenant and I want to keep you at any cost because you pay on time or whatever. But it no longer becomes a market-driven negotiation. So you need to be aware of that. I'm not saying you need to dump it as data, but you need to be aware of it. Secondly, we have to look at change in market conditions. So it's really the date of execution. The more recent the date of execution is, the more relevant the lease is to current conditions. Then we get on to the simple things now. Location, differences in locations. What are the location parameters? What are the differences? You're getting into land economics. So distance from distance from commercial centers, availability of utilities, availability of access, meaning public transport. And you get onto the basics of the space itself. So you're looking at the differences in the physical output of the building. So you're looking at layouts, amenities, standard of the interiors, the level of build-outs, i.e. are you looking at a shell or are you looking at a unit that has been kitted out? And you're going to make subjective adjustments for these again. Where you don't have sufficient comparable data, as in the data set you're looking at, the rental set you're looking at does not completely match yours, then you have to look at the next best available data set. And here you're getting into a little gray area because of course you're going to have to make more adjustments, which is going to rely on your judgment. So no different than market value. You're taking a data set, you're making adjustments for the differences between the two. The factors you're looking at are a bit more in-depth and on point, but not unfamiliar for what we do. All right, once we have assessed what our income is, or rent is, the next side of the equation is to net down that rent. So we have to look at two things. We have to look at our expenses and our replacement allowances or major repairs. On the expenses side, it's fairly simple. One of two things pertain. On some commercial properties, you will have it defined that the rent is defined versus an additional rent, which takes care of maintenance and capital allowances. In a lot of cases, that's not the situation. You will pay what is a gross rent and the landlord will be responsible for undertaking certain repairs, and the lease may speak to other repairs that you may be responsible for. Again, here it gets a bit gray. A lot of leases are underwritten, meaning they're very basic one-pagers that don't specify a lot of things. So it might simply say any repair under $5,000 is yours and mine is anything over that. Then you have issues of under-maintenance of buildings where landlords allow the building to depreciate. So all of these things have to be treated with, and as the valuer, that's part of your job. So at the date of inspection, you need to look at the physical repair of the property. What you're trying to do is create a simulated set of accounts for what it would cost to maintain that building properly, right? So on your expenses, you have fixed expenses and variable expenses. Your fixed expenses are simple, your property tax and your insurance. Those things, property tax you can get off a tax roll, insurance you can do from a replacement cost. Right? On your variable expenses, you have all your costs, now, security, utilities, whatever else. Here you can simulate these quite easily. It takes a little bit of time and effort, but if you look at a set of maintenance accounts for most buildings, it gives you a good starting point. If you ask the landlord, in instances, he may have some amount of information he can share with you. Typically, what I see that we do locally is we try to use a percentage of the gross rent to represent outgoings. And I've seen where it's used anywhere from 10 to 25, 30%. Don't like it necessarily, it's hard to support. And therein lies the problem when you can't support something. So if you throw a percentage at me, you're going to have to be able to explain. So for me, it's always easier to simulate it than to throw a percentage at it. And again, the items that you're picking up, they're not so numerous that it's difficult to attempt. And I'd say this, if you develop a quick little spreadsheet for it each time around, it's just plugging in numbers to see what it looks like. When you get a better feel for it, you'll probably find out that yes, the range is tightened up from 10 to 25 to 17 to 20, but even then, why not do it if you can? The last part of that now is the replacement allowances and major repairs. These things are of interest to us because when you're valuing, you're taking an income, you're capitalizing it to find an indication of value. That value, that income, number one, should represent what the property can generate. But that value, is it the true value? Meaning, are there things that are outstanding that needs to be done to that property? And this is something that comes up at the point of your inspection. So capital allowance and major repairs. You go into a building and you see a few watermark ceiling tiles. You ask a question. Are there active roof leaks? The landlord says, you know, man, fix them long time. The tenant says, every time it rains, places are sick. Right? Is that a major repair? Does it warrant your going on the roof? Meaning, how far does your warranty go? How far does your responsibility go? I would say this, if you see something and you can note it, then you're responsible for finding out about it. So if you're going to take the word of the landlord that it has been repaired, then say that. Say that you see this repair being watermarked ceiling tiles or ceiling, but you have been advised by the owner that the problem has been fixed and that part of the repair is outstanding. Right? What you're simply doing is covering yourself. So major repairs, Kadion brought this up to me or asked me about it specifically. When you look at things like standby generators, air conditioning systems, alarm systems, fire systems, again, we're not specialists. You're not going to know what condition they're in. If there's a property management company, they can probably tell you and they can give you the last service contractor's report. If there isn't, you ask the owner, is there a service contract? If the answer is no, then you ask the question, do you know? You ask the owner, does he know the status of the equipment? If you look at the equipment and you can simply see that from the tags on it, this air conditioning unit is over 15 years old, it's obsolete. Yeah, you can make a phone call and ask any reputable person a question. So this is the brand and model that I saw on this building. It appears to have been there for X period of time. What would your recommendation be on such a unit? Is it due for replacement? Does it have more useful life left in it? And why? Because if it's overdue for replacement and you're really just propping it up with a whole bag of repairs, that's a capital expense that needs to come out of your value. Right? That is a figure you need to account for specifically. If your roof leak is not just a drip and it's the entire roof that needs to be waterproofed or changed, that's a capital expense and it needs to come out of your value. Anything like that that you can find, you have to account for. Second side of the equation, after you get out to the income side, is your rates of return. We're looking at direct capitalization using our risk yield or the discounted cash flow using a yield rate. Very generally about rates of return, they're influenced by two things, well, several things, but a few things of interest that you would want to know is they are to reflect the perceived level of risk apparent from an investment type. So if we're dealing with real estate, some of the problems you have are the bulkiness, the illiquidity, and these kind of things. These are factors that come into play right away. All of our valuations are future looking. They're not historic, unless that's the definition of what you're trying to achieve. But generally market value is future looking. You're looking at income in the future. So what you're really looking at is future market expectations. And what you'll want to look at specifically is expectations for inflation, right? Where are you now? Where do you expect to be in another 3 to 5 years? What's the status of your economy? Growing, declining, stable? These are things that you start to think of when you start thinking of how you're going to strike your rates. You're also going to compare it with the rates from similar investment types. So for real estate, you're going to look at similar things as in bonds and stocks. You're going to see what kind of returns are they getting. So all you're doing with assessing rates is you're going to keep narrowing the band until you get to some place of your own comfort. So if you start talking to people about income and cap rates, well, income rates in particular, or discount rates, and you start talking to investment advisors or your fund managers, they'll tell you what their target rates are, and that's what's of interest to them. And as a valuer, it's of very much interest to you because it's a future-looking rate. But you're going to find that they vary also, and they will vary for reasons not solely economic, but more to do with their company profile or where their company wants to go. Right? So there's a lot of back and forth. There's a lot of questions you need to ask to try and figure out about rates. Last thing you can look for rates is debt rates, because pretty much debt rates and equity rates are somewhat related. The risk premium between the two being the difference, i.e. I'm using my capital versus debt capital. So quite often, if you look at debt rates, it should give you a floor for where you're trying to look. All right, let's just go into the valuation process. So under the direct cap, you're going to use a stabilized income, a stabilized rent. So here, quite simply, gross income. Gross income is all income that the property can generate. Rent, service fees, any other income, such as parking, roof rights, signage rights. There are a lot of things you can gain income from a property. All of those are real property rights that you can trade, and all of that is potential income. So we're going to take all of that as gross income. First step, we're going to now take out all the outgoings, which is all the known fixed and variable expenses, right? Like your service charge. Sorry, my other screen just went off there. Like service charges there. After that, we're going to go and we're going to take off our allowances for voids, collection loss, late payment. How do we account for voids? I will tell people that the easiest way to account for voids over the lease, over the life of a lease, is to look at the length of the lease. If you have a 5-year lease, so if you're writing typically 5-year leases in an economy, the expectation could be that, let's say, a half or a quarter of those may not be renewed. So at that 5-year interval, that space may go back on the open market. So the question you ask yourself as of today is, how long would it take to rent that space? So if you say to yourself, okay, let's say it takes 4 to 6 months. Okay, 6 months. So every 5 years, 6 months is taken off of lost income, of no income. There's your voids. Yeah. And I suppose if you impute further that, well, less than half of it or 40% of those leases are actually going to turn over, then you make that 40% adjustment to that figure. Late payments and collection loss come straight out of property management. If you've done it, it's real. Collection losses, every month you send out invoices for rent. And every month you get a check. And some months the check isn't the same check as the last month. And they're going to argue about the fact that the AC wasn't serviced, or this wasn't done, or this parking spot that was theirs wasn't available, and they're going to write you a different check. You have to go back and collect that money, and quite often it doesn't get collected in any short order. When you close off your account at the end of the year, you will see a figure of which just represents rents not collected. Will you collect them in the future? Who knows? But it's actually a loss of income. And put it this way, even if you do collect it, it's loss of opportunity. There's an opportunity cost attached to it. Yeah? So it's something you can account for also. And if you talk to property managers, you can get a very good feel for what that is. The next thing we're going to make an adjustment for is what we spoke about earlier, which is capital repairs, major repairs, and capital allowances. If you have something that has to be done, it has to be accounted for. So in your direct cap, what you'll do is you'll go ahead and do the valuation. You'll take the income, capitalize it, you'll have a capital value. You need to take out that repair from the value as a whole sum. Right? It has to be accounted for. That air conditioning unit, that has to be changed. That elevator, that has to be changed. The roof repair, it has to be accounted for. And the whole point is, if you as a valuer know of it, I think you'd be negligent not to address it. There are two different ways of adjusting for capital allowances. You have what I just said, which is a specific adjustment for it. I know of instances where valuers actually try to adjust their all-risk yield to take care of it. Can't say I fully appreciate it or understand it well. If practice dictates that you can find a representative number that you can use, well, so be it. I don't know of it, but I've heard of instances of it. That's something that anybody can enlighten me on a further discussion. Let's go into discounted cash flow. The elements of your discounted cash flow are not dissimilar. You're going to take an income flow, this instance, instead of 1 year stabilized income, you're taking an income flow and you're going to project it over a holding period. The holding period pretty much is saying, well, I bought the investment today, I'm going to hold it for an anticipated period of X to Y years, at which point I'll dispose of it. So the valuation elements are the rental income in between and the disposal, the reversionary income, the reversionary value. Well, it's income anyway. That holding period, typically for discounted cash flows for real estate, is anywhere from 5 to 10 years, 15 years in exceptional circumstances. What really determines the holding period for me is what you're trying to achieve during that holding period. Are you trying to stabilize rents? So is it a case that you have the property over or under rented? Is it a case that there are a lot of vacancies? You are now trying to bring the building back to a stabilized level of occupation. So the vacancies you should be having should be no more than frictional vacancies. And frictional vacancies are defined as those vacancies in the market that helps the market to operate normally. So people needing to move from space to space, that kind of space is the frictional vacancy. So whatever that minimum figure is where you want to bring your valuation to. So if your vacancies are high, you want to bring your valuation to the point of full or near full occupancy. If your rents are low or high, you want to bring it back to what you consider market rent as of today. So in your cash flow, you're going to use your actual contract rents for the period that they exist, because that's the revenue you're getting. At the end of those, you have a determination to make. Will you be renewing that rent on the same basis, or will you be seeking a new tenant? These are decisions you make as a valuer. Once you go on site and you meet with the owner and you meet with the tenants and you see what is happening there. For your more prime buildings, you find that tenants tend to want to stay. For less prime buildings and secondary buildings, they tend to have alternatives. So if it's under-rented, grossly under-rented, the landlord's objective is to get the rent back up to market. The tenant's objective is to keep the rent as close as it is to where it is. So the landlord giving up a tenant is simply based on, are there tenants available to replace them? So this is where you come in as a valuer. You're going to make the call on all of these kind of things to say, yes, the likelihood is at the end of that lease, the tenant will be changed or the rent will be brought back to market rent. So you choose your holding period to stabilize your rent. Are there major repairs that are needed now, overdue, or due shortly? You can account for them specifically in your cash flow. You put them where they are. Changing the AC units next year, put it in. Changing the elevator in 2 years, put it in as a capital expense right there in the 2 years now. Right? So all of your cash flows become apparent. You're now stating what all of them are. Last thing is to choose an appropriate discount rate or cap rate. Choosing a cap rate we discussed already. So it's the same thing. The cap rate is going somewhat further in the future, depending on how far your holding period is. You may want to make an adjustment for it. Here again, we're getting a little cloudy. A lot of people will tell you, oh, 0.5%, 500 basis points, 1%. I've seen people doing 2 to 5%. For me, it's simple. Justify it. What's your basis of moving it? This is the information I know today, and it suggests to me when I do my research that my cap rate should be 7% today. In 5 years, what it is I know today that's going to get me to move that. Okay, I live in Jamaica, and historically, we have had high inflation. Okay, fine. More recently, we have had very good, stable single-digit inflation. What's likely to happen in 5 years? You want to bring in COVID factors now and say, well, you know, things are a kilto. We're likely to go back to a high inflation regime. You can make that call. You just have to be able to justify it at the end of the day, right? That's for you as a valuer to justify. You're going to have people on the other side of your table who are consuming your reports who may feel differently, but your opinion is your opinion. And my opinion is, as of today, I would expect cap rates to move upwards over the next 5 to 10 years. How much so, I don't know. And because I don't know, I don't tend to want to go 5, 10, 15%. No, I'll stick at 1 or 2% because I know no better. Right? And I'll leave it at that. Right? On the discount rate side, it gets way more interesting. You have different things you can do here. You can do what they call building out rates. You can start at your kind of risk-free rate, which in Jamaica could be your minimum bank lending rate from the BOJ to commercial banks. And then you can add for the various risk elements. So the illiquidity of real estate, the bulkiness, the blah, 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 and you can try and build it out. Hardest thing ever to justify. All of those adjustments that you're making, it is the hardest thing ever to quantify and put a number to it and justify that number. So yes, it's something you can do. It's not something, I've tried it several times and it's nowhere near what everything else is telling me, right? I have tried it as far as going back to LIBOR, which is London Interbank Rate, which is considered the safest rate, using a sovereignty risk for Jamaica of 4.5%, which a lot of the lending agencies will tell you. And then you start building out for various elements. I tried it with hotels, and I end up with nothing related to anything else that investors are looking at. So unless you're an economist, I wouldn't suggest walking down that road. It's a long and twisted road. Typically, what I would suggest is this. You're going to do a market survey. You're going to gather people's expectations of rates. And the people that you want to look at are your investors and buyers, your sellers, your investment advisors, and real estate brokers. These are the people who are talking to each other about buying and selling real estate. These are the people who are making decisions as to what kind of returns they're looking for on this real estate. So they already know what the income is today or the potential income is, and what they are plugging in is their own kind of rates of return to get to these value questions. Sorry. So a lot of the time with fund managers, you can ask them outright for each asset class, what is their target rate? And again, bear in mind, what we're looking for is not a historic rate. It's a rate looking forward. So what is actually of interest to us is their target rate. Historic rates you can actually take out as you can take out cap values. So you can decapitalize a sale. You can pretty much find the internal rate of return on a sale and say, yes, this is how it has performed, and that would have been the discount rate. But that's historic. It doesn't speak any at all to how somebody feels today looking forward. It says what has happened in the past. And it doesn't even say what happened when they started. It just says this is what has occurred. So as of today, when you're looking at discount rates, the rate you're looking at is how people are projecting from today going forward. It's not your rate, it's their rate. So you want to talk to as many people as possible in that sphere and see what is the like-mindedness there. We're not looking for averages. We're not looking for middle values. We're always, as values, looking for modal quantities, what most occurs, right? Because again, I'll put it to you, various fund managers and various investors there are different things that they're looking at, right? There are different targets that they're trying to meet. So some of them, their target rate isn't going to be related to the others because they have a variable in there that nobody else has. So what you're trying to get back is the modal value here. You want to see what most occurs in the market between investors, sellers, and people looking at these particular questions. Finally, the conversion process is simple on a DCF. You have your holding period, you have your projected cash flow. You may have a growth rate implicit in it. Depends on what's most typical in your economy. In Jamaica, what's most typical is leases come with a rent review clause annually at a set percentage rate. Currently, I still see them writing 5% and 7% and 10%. I don't know if they're getting them. I don't know that going forward, they'll still be getting them. So I'm a bit more conservative than that, in that I had looked at it maybe, and I'm guilty, looked at it maybe 5 years ago. And what I found was we were writing all kinds of leases showing increases, rental increases of 5 through 10% per annum. And when you looked at the actual rent increases over a 10-year period for a given building, they didn't average 1.5% to 2%. And it's just a reality. So you'll write the lease, everything goes wrong as usual, and you have a choice. The tenant will go to the landlord and say, well, not paying you anymore. You need to hold the rent, or I need to go. Right? And a lot of the times the rent will be whole, because in Jamaican parlance, no better, no older. That is the rent, right? So you can give up the space and you can try and find a tenant in a soft market. So in our lease cycles, you'll find that a lot of the time, all of these fancy leases with these nice 5 and 10 and whatever percent increases actually don't happen. They typically only happen, I find, with your AAA tenants. Those tenants know what they're signing on, and people will take them to court, so they will pay. But on average, a lot of those increases are hit. So what I found, just looking at buildings that I have valued year on year for too long, on average, it's somewhere in the region of 1.5% to 2% growth at risk. That is. On the cost side, projecting, it's simpler. Once you have done some kind of calculation of what the outgoing should be, then in my opinion, you can simply move forward by increasing that by what you consider to be a reasonable inflation factor going forward. I've always maintained that even 10 years ago, when inflation was double digits and high double digits, you can't use that in valuations because it's not a sustainable matrix. That is the message of gloom and doom. If you have 15% year-on-year inflation, that's hyperinflation and that's collapse, which can be what you're predicating a valuation on. So you always have to say to yourself, what is sustainable and where is it likely to end up? And to me, if you're doing long projections and you're using more than 5 to 7%, you're talking hyperinflation and you're talking collapse. Don't know that it can work. I don't know that it's a sustainable question, meaning I'd question it easily and successfully, I hope. I would challenge it. Right? So you want to look at something as a sustainable inflation to drive your growth in expenses. On the reversion side, you have two things. You're projecting your rent forward by what you consider to be a sustainable rental growth factor to the end of the holding period. And then you can capitalize it by your terminal cap rate, which is the same cap rate adjusted for time, however you feel like adjusting it and think you can support. Or you can use some other proxy. So if you're looking at a property where there's a lease and the lease speaks to a specific option for purchase at a specific time, you can use that option depending on the definition of the option. So if the definition of the option is, I will sell it to you in year X at Y price, or it fixes a price to an index or something that you can figure it out, you can use that as a proxy. That's pretty much it for the presentation part. Few things that you need to think about coming out of this that I want to discuss is, one, how do we assess market rents in Jamaica? Are we doing the research? And here is where the key problem is. Research of market rents can't be sitting down looking on MLS and simply saying, oh, this rented in June for $1,200. It still requires further intervention. Talk to the agent, find out the details of that deal, because what's not going to show up on MLS is any rent concessions. What's not going to show up is any concessions that the landlord has made in terms of extra provision of facilities or kit out. None of that is going to show up, right? It's incumbent on you as a valuer to ask the question. It's always, the excuse is always going to be that nobody's going to answer you. And I'm not going to say you're wrong there. Most people don't answer you, but it doesn't stop you from asking. You have to ask. Our job is a simple job, and our job is about research. And our job is about research in real estate. One of the most uncomfortable topics ever. You're asking people about their big money purchases. Right? 10 to 1, they'll try and mislead you, which is why when you're doing an inspection, you want to talk to the tenants. If you go to a building that's well managed by a property management firm, you are going to meet the property manager on site. The property manager is going to take you where they want you to see in the building. They're going to keep you away from the tenants they don't want you to see. They are going to massage the hell out of you, plain and simple. That's not your job. Your job is a job of discovery. When you walk into a tenanted space, you try and engage whoever, the highest level you can find in there, and you ask simple questions, right? Any problems? Your plumbing is okay? Any leaks? Any this? You know, see how familiar you can get and see how much information you can get disclosed. See if you can find another in to find somebody in the organization who will be authorized to speak to you, and you can get some more information. That's your job. Your job isn't simply to look at things on the face, for face value. That's for everybody else. You're the real estate professional. Your job is to go sleuthing, unfortunately. Right? So the same thing with equipment. You're going to sit down and say, no, I'm not an equipment expert. Why am I going to be commenting on air conditioning and elevators? Of course you're not an equipment specialist, but it's your job. So your job now means look at that lift and try and figure out the age of it. Is it a new lift? Is it an old lift? Are the mechanicals in order? Are the switchgear in order? Is it a digital lift? Meaning, is it the most efficient lift out there, or is it nonsense by today's standard? Does it need to be changed, or can it stay? Right? Because an elevator now can cost you 11 million up. It's not a cheap item. So it's not something to be ignored. Air conditioning is working perfectly. The building is cold. Air conditioning good. No, air conditioning could be the worst thing ever. And it's overly cold because the sensors make no sense. The electronics and the digital switching, nothing on it makes sense. So it's just running at full blast and burning current like nobody's business. And you want to get rid of it tomorrow because that's going to affect your bottom line. There is something implicit in the rent that, well, it's my secret to rent. And my secret to rent is this. A tenant doesn't write a check and say, this portion is net rent. This portion is maintenance. This portion is tax. A tenant writes a check for $1,700 and says that's rent. I don't care what you do with it or how you split up, that's rent. So the more you can make out of that $1,700 as net is the better off you are. So the more you can reduce that outgoing portion out of that $1,700 is the more value you create in your own building, right? So it's incumbent on you as a valuer to explore these kind of concepts. On the discount rate side, I don't think it's ultimately very challenging because it's really forward-looking. It's not a historic figure that you want. And if it's forward-looking, then the research becomes more cogent. It's discussion and debate. And why I say debate, because you will speak to people and they will tell you point blank, this is their target rate. The debate part is to try and figure out what they're targeting, right? If on average you find your modal values for target rates to be 7 to 8.5%, and somebody is insisting to you that it's 10.5, then you have to find out from them why. Why are you at 10.5? What is it specifically you're looking at? What are your considerations? Yeah, it's not that they're wrong, but you need to understand what it is they're targeting. And that's the same thing for the 7.5, 8.5. You ask the question, they will tell you, right? These people are better schooled at financial mathematics and economics than we are. They will tell you point blank that this is how this asset class is performing, and this is what they need real estate to perform at to get a correct beta weight to make sense in their whole portfolio, plain and simple, right? So you have to ask questions. You can't be afraid to ask questions. You can't be afraid that you're going to be exposing yourself either. Right? That's the wonderful thing about this age that we live in. Computers have a lot of information on it you can get. You have a lot of colleagues who you have readier access to than you did previously. Ask a question. And if you don't have the information, somebody else may have gotten the information by some other means. It can only help all of us to the extent that everybody shares information. Right? I have no problem sharing information because information itself isn't king. It's analyzing information that's king. Right? I don't think I have much more. No, I think I'll wrap up right here. I think I'll hand it back over to Ramesh, Mr. Reed, and we can start whatever Q&A there is.
Okay, thank you very much, Sir Allison. And indeed, word to the wise is sufficient. Very good presentation, and thank you for the time you took to prepare and advise us on your findings. So we'll be facilitating the question and answer section now. The format we'll be using is as follows. We will be asking participants to use the raise hand function, and we'll allow you to become a co-host for a short while, and then you can unmute your mics and ask a question. Additionally, you can utilize the chat as the admin person has been pointing to, and we'll answer Allison those questions as well. So the question and answer section is officially open. So, Sir Allison, probably this means that the presentation was super excellent. We have a question here from Sam. Okay, I have a question from Jermaine. All right, so let's read Listen Graham's question first. Curious to know what types of leases you have in Jamaica for A-class office. I'm not sure what these abbreviations mean, Listen. N and NN. Also, do you quote rates on an annual basis per square foot? Net or
The answer is yes, we do quote rates per annum on a per square foot basis. For AAA class properties, we tend to do triple net, NNN. I think the whole region is similarly affected by the North Americans. So yeah, we do what everybody else does there. You're not going to find much difference. That's more going to pertain, especially in our resort sector of the market, where it's a little more competitive. On the prime office side, we don't tend to go triple net at all. So that's the short answer.
All right, so question from Jermaine Williamson. Please explain the difference between the cap rate in the straight line approach versus the discount rate in the cash flow.
The cap rate in the straight line approach versus
the discount rate in the cash flow.
They're not really related. I'm not following the question, Jermaine. Can you restate the question for me? See if you can restate the question for me, Jermaine. I'm not following. fully.
Jermaine,
So
you
we
can
still
go
do.
ahead and speak. Your co-host.
Hi, Karl.
Hi,
So
how you doing?
the approach deriving both rates, right, seem very similar in your explanation in the presentation.
The cap rate and the discount rate?
Yeah. So the
No.
all risk yield in the straight line approach, you
Yeah,
explain
no.
that?
Well, maybe I didn't discuss the all risk yield enough, because pretty much with the all risk yield, yes, you can extract it from previous sales, but again, it's a historic rate. So you kind of want to take that as your basic and move it forward. So moving it forward now would be looking at the differences with the subject property and the property that that one pertains to, and your outlook on economic changes and all of those kind of things. I thought I spoke about that. So pretty much you would use kind of a base rate or a historic rate and move that rate forward on the all risk. The discount rate is really just a forward-looking rate of return, because the difference between the two, one is a rate of return and one is return of and on capital. So they're not really related. So if I didn't explain it, my bad on me.
All right, thanks.
Not hearing you, Ramesh.
All right, so we have a question here from Alistair Smith. I'm asking you to go ahead now.
I can go now?
Yes, sir. Go right ahead, please.
Good day, colleagues. Excellent presentation, Sir Allison. Could you kindly go over the reasoning for your holding period? Because I was always of the opinion that the holding period is generally determined by the tenure of the lease.
Put it this way, if your tenure of your lease is 5 years or 10 years, and there is nothing interesting about your lease, the rent is pretty much at market rent, and there's nothing happening with the building, meaning there are no capital repairs outstanding, the building is stable, then 5 years. What I would suggest that you want to look at is not just the lease, it's the building itself. It's the occupancy of the building. Is the building fully occupied? Is the rent at market rent? If it's not, we need to get it there. So if the lease is 5 years and it's under rented, I still need more years to get it back to market rent. Yeah. So there are more factors than just the lease. The lease is the least of your factors, so to speak, because if your lease is stable, then 5 years is good. All is right in the world. We move on. But if there are other issues to be addressed, we need time to address those issues. Right? So if there are occupancy issues, if there are rental issues, if there are capital repair issues, those have to be addressed.
All right, thank you.
No problem.
All right, thank you, Sir Smith. We can take about 3 more questions if there are any takers. All right, so we have a comment and question from Mr. Eric Allen. Superb presentation. I have seen examples of rent being quoted on the gross external area. What's your experience of this?
Locally, it's all a shamble if you ask me. We go in and every building that we do, we measure. Some of them might be a bit too much to be measured, and you may use some as-built drawings from some architects. But those figures are all over the place. We write quite a few reports where we actually put a caveat in there that we recommend that the area be resolved at the earliest. You will have, and this comes from my property management experience, you will have instances where common areas like landings for elevators and common area bathrooms, common area kitchen storage are prorated by area and rented back and given to you in your rental space. Yeah, you will have instances where the gross let area of the building is more square footage than you can measure any which way you try. Right? And again, it's your job to bring out these points, because for me, the simplicity is this: you, the tenant, and me, the landlord, we have agreed that you're going to pay me this rent. Right? So we have had tenants who come from it and challenge and say, but the square footage they're telling me is not this. What is the actual square footage? Again, here's my caveat on that. I'm not a land surveyor. I have been asked by clients to resolve building areas or letters areas, and I don't like it personally. A land surveyor has to have his tape measure checked and certified on all these things. I don't. 10 of us can go measure the building and come out with 10 different figures. I don't say that I am the expert for measuring anything. So when I measure something, I will state that it's our measurement. Where I'm a bit lax is IMPS. I've read it. I don't know that it changes significantly what we do, but I haven't even mentioned it in my report, in my reporting yet, which that has to come shortly. Yes, but I don't know that as value as I like the idea of our being the ones to dictate anything about measurement. I do know that there's a lot of queerness out there in the marketplace in terms of figures. So I bought this property, and the man who sell it to me tell me it's 2,200 square foot, and I rent in 2,200 square foot, and I'm done. The first value I will go there, don't find more than 1,800 square feet. Rent paid, you can now go calculate it and say, well, you know, he paid this rent on 1,800, so this is the per square foot. Right? But the intention was clear. The intention of the lessee was clear. I was renting 2,200 square foot at this rate per square foot. So my answer to you, Eric, don't know. If somebody has to get involved at that point.
Thank you for that response, sir. Right, so it seems as if
I think as values, we just have to point out these problems. Sorry.
Okay, yes, sir. All right, so just on the back of that comment, Sir Allison, is it that we should make these findings known before engagement, or is it that we should have disclaimers in our work to state the findings?
I don't think it needs a disclaimer. It's actually owning up to your own work. It's to say that this is my finding. Right? You are not an expert on measurement. I've read ALEVS, but I'm not an expert on measurement. There's nothing that tells me I have to go certify any tape measure anywhere. I have a tape measure from 1909. That's fiberglass. That's so stretched out that a foot is a foot and a half. You're going to sue me? You don't have a basis. Right? So I am not the person to take measurement. Meaning, yes, I do it because it's part of my job, but am I certifying something? No, I can point it out. This is my finding. Now, if it stimulates you to say, well, I thought it was, then I say to you, well, get a land surveyor. And I've done it several times, and the land surveyors themselves don't want it. But that's where it belongs. It cannot belong with the value.
Okay, thank you very much. All right, it seems as if we have another question from Alistair Smith. Right, you can go ahead, sir.
Sir Allison, this is a follow-up question somewhat from Mr. Allen's question earlier. What I'd like to know, is there a general percentage that you would use to, if you have an external building, if you have the external gross floor, if you have the gross floor area of a building, and you would need the internal measurement or the approximate internal measurement, especially when you're analyzing sales and you're trying to extract a yield. You don't know the internal area of a building. You can't go into the building to measure the building, but you can get the external area of the building, especially say a retail building downtown in which the building covers the land size, and you can easily get that building size in terms of the gross floor area. Is there a general percentage that we can use to get an approximate internal measurement for that space?
Your question is flying straight in the face of IPM. I don't want to answer, but the obvious answer to me is if you can tell me the length and breadth of that building to come up with that area, then you can easily impute that the walls are of a given thickness and take that out to start. Whatever other internal shared areas I can't help you with, which is why I wouldn't want to try and answer that question. Typically, a lot of people say 5 to 7.5%, and that's through practice, you'll find that, yeah, might be in that range, but that's all a function of architecture. You go into the building and you find a nice big atrium in the middle of it all of a sudden that you didn't know. Not a safe thing to do.
I wanted to know your lucky figure, but thank you.
I don't know if it's a lucky figure. When we end up in court, we'll find out.
All right. Thanks much for that. All right. So we have another question here from Shane Jones, and after that we'll take a final one from Neville Rice. So Shane Jones' question is as follows: what is your view on arriving at a all-risk yield based on a gross rental and sale price? Hold on.
Well, if that's a question, that's a question. That's fine. All I have to say to something like that is consistency. If you're going to use an all-risk yield as on a gross rental, then you're going to have to apply that kind of factor to gross rentals for your subject. Is it the most elegant way of going about it? Absolutely not. Because the difference between the facilities in the building and even the mechanicals are going to determine the actual levels of outgoing. So it's not the most elegant way to go about it. It's not something I really want to do.
Okay, all right. And part B of your question, when valuing the subject, would you apply that same yield to the net rental figure?
No, that's what I just said. You can't. You have to be consistent. If you're going to do it on a gross, you have to stay on a gross basis. So if you start on a gross basis, stay on a gross basis.
Okay, wonderful.
But I wouldn't recommend a gross basis because it's a gross mistake.
Okay.
You're starting on a very unsteady slope there.
All right. All right. So from Never Rice, have you ever used Google Maps to arrive at an approximate site area if there is no survey available?
No, in our office here, we have that argument every day. My answer is no. If you check it, and it's a simple exercise for me, what I do is check it. Here is the known area of the land. Here is Google Maps. Here is Google Maps area. Are they the same? No. Answer is no. Leave it alone. You want to get more elegant now and say, okay, if we know that the relationship between Google Maps and the actual area is 0.75, so if I use the 0.75 on that, am I right? Not going there. Not going there. It just means there's no data for me.
Right.
If you can't find it, leave it alone. And that is a problem I'm having with a lot of valuations now. You have more information available to you than we had 10, 20 years ago. And there's an element of laziness that has crept in. You need to hit the ground. When you go to do an inspection, you can't have all of this data of all of these sales and have to have a piece of paper and go back to your desk and look at a piece of paper. You just went to the neighborhood, look at the properties. How can you not look at the properties? You don't know what this figure means until you see the property. Right? You're guessing. Right? Google Maps showing you the outline of a roof. And it's telling you that when you set it out, that is this area, it don't mean nothing. When you gross it out, what then? You didn't do your work. It's the long and short. Can't do it. You cannot use it.
Thank you, Sir Allison. And as that question was...
Or is it not a desk job, ladies and gentlemen? It's not a desk job.
Right, right. Thank you for those stern and pertinent comments. Yes, and I see Mr. Ryan Taylor, our president, agreeing. who has some land surveying qualifications and experience as well. So he's enjoying that comment. All right, so we mentioned him at the right time because we're gonna move over now to receive his message to us. But before he comes, we'd just like to thank everyone who participated in this section. Both questions that were asked and those that remained in your minds, right? I hope they were resolved. Thank you again, Sir Allison. And we go right over to our president, Mr. Ryan Taylor.
Thank you, Sir Reed. And first of all, I want to thank Sir Allison for a great presentation. I must say that he was very detailed, and I must say I left learning a lot, and I really appreciate the sacrifice that he has made to just put out the time to facilitate this type of presentation. And I must say that I'm in sound agreement with him as it relates to some of the concerns that we have. I believe that as valuers, we need to first understand that we're research officers, and when we get the work to do, we can't just take the data like that. We need to actually look deep into the data, understand where the information is coming from, so that we can make sound decisions. And inadvertently, it will resonate to our clients and the wider industry that we are actually doing what we are paid to do. You know, so I really thank him for reinforcing that and everything that he has presented today. I just want to say to the members, and this message is generally to the members of the association. We are celebrating 47 years this year, December. And during that time, to today's date, the real estate industry has experienced several changes, right? One such change relates to just information, as Sir Allison has said. And you know, the fact that information is now so wide, right? It runs across borders, country borders. And so this has caused for different standards now to increase, right? Clients believe that they are now real estate professionals because information is there, and they feel like they are now real estate professionals. So the council has understood now that that is a time for change, right? And because standards are increasing and there's a need now for change, we have opted to revise the Constitution. We believe our members, with the review of the Constitution, should not be only seen as valuers per se, but we should be seen as real estate professionals as a whole. I believe that over the years, we have just been aligned to one section of real estate, but I believe that every valuer here, with the training that we have gotten, we can do valuations, we can do auctioneering, we can do property management, sales, development, the works, because we have the training. So the council believes in widening the association's scope. We want to do this because we want for people to understand what we provide as professionals. The review of this Constitution will establish growth and sustainability, and this is of high importance to the council members. To date, the Constitution has been sent to the review Constitution has been sent to the council, and we have reviewed it at our last meeting. Soon enough, we will be sending it out to you, the members, for feedback. it is very important, and approval, let me say that. It is very important that we take in consideration the move that we are making as an association. We really want you all to be involved in this process. It is 47 years that we have been established, and we want to grow into a different frontier, because the point is the standards have increased, and we have to increase with the standards or we'll be left behind. I believe our profession can achieve great things, but we have to do this together. We have to be in one unit. And as such, I ask that when we actually put out the messages, that you will see the need to get involved, because at the end of the day, this association represents not me, but it represents you and your work. So as we move forward in this direction, again, I ask that you participate as we try to build a foundation that our forefathers built 47 years ago. And we are trying to build this foundation for the betterment of our students and longevity of our profession. I want to thank you all for listening, and I do look forward in you being involved in this major, important change that is happening within our association. Thank you.
All right, thank you, Mr. President. Right, I know you didn't hear any encore, but we appreciate your message nonetheless. All right, so we are pretty much at the end of our proceedings. It was a session that was very informative and really sharpened us, and most importantly, gave us some pointers, some line items that we should consider as we move forward in doing our jobs. So again, we'd like to thank all the participants that turned out. We pretty much had all the numbers that signed up present, and we are grateful for that. Thank you for taking the time out. We'd like to thank our different stakeholders present, also the academic staff at UTech, the ALEVS council members, all our ALEVS members, and other professionals and friends present. Thank you so much for attending, and you can look out for some further information from us regarding the next CPD seminar and also other ALEVS activities. So on behalf of all of us here, we say thank you again. Have a good afternoon, and it was a pleasure serving.